This is lecture 2 of the 4-part series about the subject of price behavior, inflation, and deflation. This is the most important of the 4 lectures. This is the lecture that covers the statistical measures of inflation, like the Consumer Price Index. This is the lecture that will be most heavily represented on the examination. And also, I do remind you that this same material is covered in more detail in the chapter about inflation that is assigned with this lecture set. So please make sure you read that. This is merely a summary overview of some of the things that are discussed in that chapter. So let's start this. We'll start with the Consumer Price Index, which is meant to be more or less a kind of a cost of living indicator for the typical person living in the United States. It is a survey that is expensive to pull together, and here are some background information about what they do. This changes a little bit from year to year, and I didn't change it this year. So the numbers may not be exactly the same in 2020 as they were in 2018, but they make price collections monthly and bi-monthly in 85 urban areas from about, the last time I saw the data, 45,000 housing units and 20,000 retail establishments for, believe it or not, 80,000 items that are included in the index. This is done with personal visits and telephone calls. It may be the case that they're gradually shifting this over to the internet, is a guess I'm making, but I'm not sure that they're actually doing that. For the Consumer Price Index, you choose a base year because it is an index, and the base year is the average of the actual indexes in 1982, 83, and 84, where that is set to 100. In other words, the current values of the indexes are divided by that average for those 3 years and multiplied times 100. And so that, of course, tells you that what the price level is now in 1982 through 84 prices. Now, they give weights to the items in the index by establishing a market basket. It's not meant to really be the market basket of the typical consumer because no one consumes 80,000 items. Instead, it's meant to represent across the board all kinds of food, clothing, automobile expenses, housing expenses, medical expenses, and so forth, to give them the kind of weight that more or less is representative of what they regard as a typical household. The weights are based upon consumer surveys that were conducted in 2013. 7,000 families keep diaries of everything they buy for 2 weeks. Another 7,000 in a more general survey covering 3 months. And the index itself is a weighted sum, and we'll sort of look at the mathematics of that right now. Each month, the value of the market basket, which is a series of weights times individual prices, where we've said the size of N in this top formula here is approximately 80,000 right here. All right, so then the market basket is calculated. Then the Consumer Price Index, which is a number like 168.24, it's not a rate, is calculated by taking the value of the market basket for each month and dividing it, if it's for the year, and dividing it by the value for the base year, 82 through 84, and then multiplied times 100. So they sum up all of these, they divide it by the base sum, which is an average over 3 years, and multiply it times 100, and that's where the number that's equal to, like I said, 168.42 comes from, that you see when you look at the statistics. And then the all-important inflation rate is calculated from the CPI, and that's going to be CPI times T divided by CPI times T minus 1. Minus 1, they use a discrete way to calculate this. And so, of course, the inflation rate can be measured by the month, by the year, by whatever base you want. These are the category weights for some of the aggregated values for January. This is the December 2019 weights and the January 2020 values. So again, the weights are from the December 2019 statistics, the values, this is how they're paired in the release, the data release, and these are fairly current January 20 values. So you can see that, of course, all items has a weight of 100. So when we go down this and we take a look at food and beverage, right here, for example, then the weight for that currently is, what happened to my, okay, it's not working very well. My mouse is not working very well. The food and beverage is 13.8%. So that assumes that the typical family would spend about 14% of their income on food and beverage. The housing weight is 42.1. There's a difference between the rent, 32.7, and owner equivalent, 24.1. This kind of goes along with what I tell people in Econ 104. Once you buy a house, then as a percent of your budget, it stops rising if you're buying it with a 30-year fixed rate mortgage, because the monthly payment becomes a constant and it doesn't rise. So obviously over time, the weight of that in your own budget begins to slip down. And so that's apparent in the national data. If the weight for rent is 32.7, the owner equivalent rent, that means the rent equivalent for a person who owns a house, is only 24.1. In looking, in addition to the weights, of course, we're looking at the index. So the okay, there we go. Now it's finally working. So the index for all items is 251.2. And again, that's based upon the 1982 through 1984 numbers. The rate of inflation for the year, and this is, by the way, January 19 to January 20, so this is an annualized rate, is 2.5%. And so if the consumer price index is thought to be a reasonable measure of the cost of living in the United States, or a good inflation rate for consumers, and it is a good inflation rate for consumers. This, by the way, is classified as all urban consumers, because this is based upon a series of surveys taken in urban areas only. 2.5% is the inflation rate. Food and beverage only rose in value 1.8%. Housing rose in value 2.7%. It's often quite a bit higher than that. And you can see that the index as a whole is a little bit higher than the all items. And so housing has been rising in value, but look how fast rent has been rising. And I'm not quite sure how you reconcile the housing overall. Well, housing overall is not just the cost of the rent you pay or the owner equivalent of the rent. Housing includes all of the cost of housing, such as utilities and the water bill and the like. And so the actual cost of the rent per se is actually rising than the other costs are. So that's how you explain it, actually. So apparel, we don't spend much money on clothing, and that is kind of apparent. And so the index for that's only 122.4, and that actually fell in value last year. This is almost all imported goods, of course. We hardly make anything in the United States anymore. The general cost of transportation takes up a weight of 15%. The inflation rate is 2.8. Gasoline in transportation, as we're going to see, is really volatile from year to year. It only has a weight of 3.4. Overall, the index is well below the index of all items, so it has been increasing in value less than the general inflation rate, but last year, January to January, it went up in value by 12.8%. Very volatile. Medical care only represents 8.8% of the market basket weight, but take a look at the size of the index on that, 490.2. So that's almost double the inflation rate of all items. And the rate last year was a staggering 4.5%. So, of course, that's one of the problems in the United States. The cost of medical care is so high. It turns out that it's a bit of a political issue, of course, or has the potential to be a political issue in this year's presidential elections. We spend 5.8% of our market basket on recreation. Small index, that hasn't been rising very much, 1.4%. I thought I would throw in education. That's not a major category, but I thought you should know what it is. Not specifically education, but college tuition and fees. There are 80,000 items in this index. There are 3 or 4 that are higher than this category. Its weight is only 1.6, but for you, it's 0.9. And the index is 874.1 compared to the overall index of 251.2. About the only thing that you can find that's more expensive than this is the cost of cigarettes. Cigarettes, I think, are higher than 874.1. The rate in the most recent year is 1.9%. There's kind of a pushback, I think, against this. You don't see it all in the colleges necessarily. Now, when you invert the all items index, 1 divided into 252, what this gives you, or 100, excuse me, divided into 252, this gives you a value that is the purchasing power of the dollar in 1982 through $84. And so you say, well, if the dollar in 1982 through 84 is equal to $1, then how much purchasing power does that dollar have in 2020? And the answer is it has about 40 cents. Now, that's not necessarily all that bad. That's a long period of time for the dollar to be devaluating in value. And it does include a couple of inflationary episodes or so. And right now it's devaluing at about 2.5% per year. So that isn't quite as significant as it may seem to you. Actually, I have tobacco right here. Tobacco's 952.3. So if you smoke and you go to college, then you're really having a hyperinflation in your life. You can always find current data by clicking on the most recent CPI news release on the front page of the Bureau of Labor Statistics website. I have down here, just as a note of interest, bananas have a weight of 0.078%. And if you go take a look at the data, you'll see it's really disaggregated into things like breakfast cereals, different kinds, and every kind of fruit imaginable, peaches and bananas and lettuce and celery and so forth. So again, when you go back to the CPI on the previous slide, let me kind of slip back there again. Boy, this cursor thing just does not work on PowerPoint at all. I guess I'll just have to stop using it. When we go back to the CPI right here, or actually the top formula, the market basket, then again, those are aggregate weights, of course. This represents the individual weight and the individual price. So for the aggregates, then the weight would be that value, like 13.78%. Okay? So that's where the consumer price index comes from. Now, you've actually seen the data before now because we've used it before. Remember, we said that from 1960 on until 2015, we had an average of 3.72%. And so shown here also are the peaks of business cycles. And we saw that we had inflation rates that were high, above 10% for a period of time. And then again, we've seen that story before, so we won't dwell on it right now. I'm sorry, this slide has 2 pieces of information, one of which is wrong, one of which is correct. Those are not the peaks of business cycles, those are the troughs of business cycles, because remember, those two peaks right there that we're looking at in 1974 and 1975 right through here, those, remember, are examples of stagflation, where we actually had the peak of the inflation rate during the trough of the business cycle. I'm not quite sure. I think on the original slide here, which are layered in PowerPoint, that I probably had peaks of business cycles earlier, and this just popped up on this one because the layer was exposed. So anyway, this is the business cycle troughs. So at any rate, we said the acceptable desired level of inflation was somewhere around 2 to 2.5%. That's represented here. This means at the current time, if that's acceptable, we're doing just fine. We really haven't had any inflationary problems actually in your lifetime for the largest part. We do know this story right here, and we'll come back to that story later. We've seen that in the earlier slide sets we've been doing. And when we take a look at 2019 and 2020, this is 2008, and so this is monthly CPI calculated as annual continuous growth rate, where I make the calculation using the log growth rate. When you take a look at it month by month, you can see that it varies in the monthly annualized numbers. Of course, it would be high if you're taking monthly annualized numbers. And the reason I did this is to show you that there was a period there between 2008 and 2009 where the monthly numbers for the inflation rate actually came down to minus 20%. Now, that was mostly due to a huge temporary decline in key commodities and especially oil. But you can see if you smooth this data, which of course you have to do if it's annualized monthly data, that it sort of gives you this pattern of inflation being tolerable here between 0 and 5%, although you can see right in through here oh, there it is. This thing just does not work all that well. You can't even see it right in through here. This is a little laser printer that PowerPoint has built into it. Sometimes it works and sometimes it doesn't. Right in through here, we actually had, even in the 12-month moving average, we had basically a short episode of deflation. And right through here, again, around 2015, prices were essentially at 0%. So that's very close to deflation. So we do have a low inflation era, and that's good, although it's not very healthy, as we'll see in the third video, not this video, when this dips down into deflationary levels. And we have come pretty close to that a few times. Okay, because of this volatility, the Bureau of Labor Statistics will release two levels of the Consumer Price Index. The Consumer Price Index for urban area, all items, and the Consumer Price Index, all items less food and energy, what is referred to as the core rate. And the core rate of inflation takes the volatility out of the inflation rate. So the red line here, once again looking at the percent of monthly change, and this is not annualized, the red line represents the all items rate, and as you can see, it's bouncing around quite a bit. And again, we see that downturn in right around late 2008, right around just before 2009, when the stock market was crashing. And that again shows the all items decline, but you'll notice less food and energy, although it declined and was negative, was not nearly so severe. And the reason for that is most of the volatility in the Consumer Price Index come from the food and energy categories, especially the energy category, because as I said earlier, the price of gasoline and related prices is really volatile. And it's for that reason that if you really are looking at the trends in short-term inflation rates or near-term inflation rates, it's probably better if you look at the core rate. The newspapers, sometimes when they report the rate, don't make this distinction, because you can see that you might have, for example, the core rate. I give up on my pointer. I have to do this without the PowerPoint laser pointer. It doesn't work. The core rate is at 1% on a number of occasions, and if that's annualized, of course, that's well in excess of 1%. But you can see, when you look at the blue line, that volatility is squeezed out. I think I said that backwards. Please don't change any of that stuff. Please leave that alone. Excuse me, please leave that alone. You're changing the light. Thank you. I'm recording this live now, so please leave it alone. So you can see how it has this tendency to flatten this out. So you do need to know the distinction between these two when it comes to exam time. Now, when you take a look at the same data from the perspective of the Bureau of Labor Statistics, here we have the all item and the all items less food and energy in the sort of one-year chart that they publish at the beginning of the statistical report. So you can kind of look at that and see how this is working out at the time you're during the current 12 months or so. And you can see once again that all items less food and energy tends to be between 2 and 2.4%. And yet all items instead of core ranges all the way from 1.4 up to 2.4. So in other words, if you're looking at short-term energy measures, you want to use the core rate. It squeezes out the volatility. The volatility looks too volatile effectively over the short period of time. Now there's our second price index is what we call, it's not a single index, it's a family of indexes. It's the producer price index, a family of indexes that measures the average change over time and the selling prices received by domestic producers of goods and services. There's also commodity price indexes, and PPIs measure the price change from the perspective of the seller. There's over 10,000 of these for individual products, groups of products, and are released each month. Finished goods, commodities, raw materials, and food. So, of course, it's very complicated to look at them. They do aggregate them to some extent, and we look at one of the aggregates so you can see how volatile it is. But PPIs are available for the products of virtually every industry in the mining and manufacturing sector, and these tend to have an index base set at 1982 equals 100. If you want to look at the entire family of them, then go to the BLS.gov and just click on the PPI tabs, and you'll see that there's not one index, there's many, many indexes. To give you a comparison of a representative sample, we compare the commodity PPI versus the CPI for all urban consumers. That's monthly at annual rates, and so of course that tends to make it look more volatile than it actually is, because you're taking the monthly rate and multiplying it times 12. And the point here, though, is that you can see when you do look at the comparison between the two, the CPI is a sort of little red dotted line in the middle, and the PPI is the green line, that the PPI is very volatile. The financial press sometimes, when this stuff rises and falls, gets pretty hysterical about it. But as you can see from looking at it, for example, in 2008, and again, a lot of this is key commodities. I don't know if this includes oil or not. It probably does. But here we have, given its behavior in 2008, 2009. So you're having monthly annualized rates at above 15%. Really high, and then of course you have monthly annualized rates of minus 15%, which is acutely deflationary. Then it rises back up to 5 to 10, and then a few years later it's back down to minus 8 or minus 9. And so the headline news of the PPI is senseless, of course, because you either have to smooth it or simply realize that it is going to be relatively volatile when it is oscillating around consumer prices. I don't think any single month's release of the PPI of any commodity or anything means anything at all, except to perhaps a manufacturer who is buying the oil or the coffee or the wheat or whatever that is represented by the PPI in question. It gets too much media attention for that reason. Our next measure is the BLS Employment Cost Index. You may recall we saw this once before. We saw this in the discussion of productivity, right? And so this is showing that between 2001 and 2019. Again, this is watched very carefully by the Federal Reserve System as a potential inflationary forewarning when it's rising. It really hasn't been high anytime during this period. 4% is a little on the high side, but as you can tell, that as the economy expanded through the period between 2001 and 2007, which was a growth period, that effectively productivity was bringing this down. And so this is somewhat inverse to what is called or measured as productivity, because remember, most measures of productivity sort of try to estimate the labor content of manufacturing and services. And so, of course, if productivity is rising, this is declining. And we talked about that. And this declined until after the 2008-2009 recession. It bottomed out in 2009. And now it is very slowly climbing. And I think that's largely due to the fact that wages are actually rising a little bit over this period because of basically a labor shortage. Not an acute labor shortage, but one that in key industries is enough to start pushing wage compensation up. We're not sure about that. I'm not sure about that. That's just a guess on my part. This is not a cause for concern, in my opinion, at least not yet. And you can see that the Fed, of course, is not going to be looking at the month-to-month data, nor should you. We're looking at the smoothed average, and this is a 2-year moving average. And you can see that although it's come down from 3.7 to below 2, then back up to 2.5, that's over a long period of time, and that's regarded as a remarkably stable index. Actually, it is, again, kind of a proxy for productivity, but it does have actual real wages factored into it also. It's not just productivity. To continue on, one of the other measures we talked about was the chain-weighted price index for personal consumption expenditures. And at the beginning of the slide I said there's a chain-weighted index for all categories of the NIPA accounts, and so of course there is. I'm showing you one of those, and that's the chain-weighted index for personal consumption expenditures. Remember, that's a key category in the NIPA accounts. And this is also regarded as a Federal Reserve System inflation indicator, although this value is very conservative compared to others during high periods of inflation. You can look back here, for example, in the 1980s or so, and take a look at that chart there where it says 1980, and that's showing just 4% inflation during the 1980s. And we were looking at double-digit inflation. And that's because the chain-weighted indexes are conservative. Their primary purpose, again, is to simply produce for us real numbers for the NIPA accounts, for the consumption, investment, government spending data, and of course for GDP. If you take a look at the Personal Income and Outlays BEA news release for February 28, 2020, you see down there circled that the price indexes, that's the chain-weighted index for personal consumption expenditures, was 1.7, and that was a January to January number, so that shows a 1.7% inflation rate. The same thing, core, excluding food and energy, was 4.6. Now, I'm not explaining what chain-weighted actually means. That's just too difficult to do. You could look that up in Wikipedia if you want to know what chain-weighted means. I think if I tried to make a stab at it, you would just glaze over. And then if I asked you on the exam about it, most of you would miss it because it is kind of complicated. But I don't know if I take a stab at that in the chapter or not. I don't remember. Anyway, I'm not asking you to know how they do the chain-weighted method. Well, that's it for the statistics that we've looked at and their behavior over time. Now we're going to take a pause here and then move on to part 3, which I recall is about theories of inflation and deflation. That's it for now, though.